unsophisticated investors often are not very clear on their investment criteria. They'd say, well, I just want to make money. Okay. But the more sophisticated the investor is, the more clear they're going to be on that criteria. Usually about a dozen of them. And you have to hit on all of them. If you get 9 out of 11 or 10 out of 12, it's not going to work.
Hey everyone, welcome back to another episode of Eat, Sleep, and Invest. I'm your host, Brian Driscoll, and I'm here with Victor Menasce. What's going on, Victor?
Great to be here.
Victor, why don't you give everybody a little background on what you do and how you got into real estate?
My pathway into the world of real estate investing was definitely not the traditional trajectory. I started out my career, in fact, as a microprocessor designer. I'm trained as an electrical engineer and spent probably the first 20, 25 years of my career in the tech industry. Rose through the ranks, led engineering organizations, always in the realm of microprocessor design, all over the world, frankly. We had customers all over the world. Ended up being part of the leadership team that managed a carve out of a division of IBM, again, in the realm of microprocessor design. And so learned a lot about business, learned a lot about business development, did one IPO, 5 mergers and acquisitions, and frankly learned how to raise capital in the tech industry, which is one of the hardest things to do. Because if I came to you and I said, I've got an idea, maybe the market will develop, and maybe in year 5, I'll get you your money back, and maybe in year 6, I'll give you a profit. Are you lining up for that investment?
Right.
Right. That's a lot more difficult play than in the world of real estate, where you say, I've got a thesis here for a particular project, but here's all the comparable data to support why that thesis makes sense. And here's how it's going to be financed, and it's not all equity. We can borrow funds. Well, what a concept! It's a very, very different thing. And so, 2009, I exited the tech industry. It was on my 18th trip to Tokyo in a year and a half. We were building a new cellular network for the number 4 carrier in Japan at the time, and it was just burning me out physically and emotionally. That 13-hour flight to Narita Airport was a well-worn path. And it was just time to do something different. And of course, at that time, 2009, there was something interesting happening in real estate in the United States. And I saw that as an opportunity of a lifetime to take a hard left turn in my career. And so I did.
And that's interesting too, because that's a big turn.
It is. It sure was.
Okay, so you're burning out on doing what you were doing there. What specifically popped up in real estate? It's like, you know what? I'm going to completely change my life and pivot.
Well, it was really back to that thing, if you're going to invest in tech, it's like saying, I want to win the lottery when I grow up. Because look at the companies that were active, especially in hardware design. If you're doing chip design, the amount of investment that's required just to design a single chip is enormous, $50, $60 million. Huge, huge investments. Unless you're driving volume, like cell phone type volumes, 12, 15 million run rate a year, it's very, very hard to recoup that investment because the life cycle is so short. And unless it's a very specialized thing where, the government's footing the bill and you're going to manufacture a couple hundred of these chips and it's going in a satellite and that's it. Very, very low volume at the other end of the spectrum. And it's the stuff in the middle that is the most difficult to finance because it doesn't drive enough volume and there isn't enough investment to justify that ROI. So it's the stuff in the middle that's really, really difficult, which is why the world of consumer electronics is so upside down. It's a difficult space. And look, we supplied into customers like Cisco, like LG. We had chips in their plasma TVs and seat back displays on most Airbus aircraft and all of these different applications all over the world. It's a tough play. It's really a tough play. So it was really just worth doing something different. And I saw the world of real estate investing as one where it wasn't concentrated in just a handful of players. Because in the world of tech, especially in the world of hardware design, unless you have the depth of pockets of an Intel or a Samsung or someone like that who really have the ability to make these massive investments, it's very, very difficult for those small or medium-sized companies to make a go of it. And often if they were successful, they would only survive 1 or 2 generations before being acquired. So here too is very, very difficult play. Whereas in the world of investing for real estate, there was no monopoly or duopoly or anything like that. Literally, you could have millions of folks generate multi-generational wealth in real estate on a global basis. And that spoke to me.
It's interesting. Now, So we were talking earlier before we hopped on here about competition in the market, things like that.
Yeah.
And you were even talking about like even with the chips, things like that. Speak a little bit about what we were talking about before and how you were explaining that.
If I look over the last several years, what we often see is what I call the auction environment, where if, let's say, a multifamily property appears on the market for sale, there's going to be multiple bidders. The winning bidder is usually going to end up paying too much. And that's what happens in the auction environment. And I just don't like auctions. I don't like paying too much. I find often that we can develop a property for far less than things are selling for in the open marketplace. And there's no competition because there's no competition for an idea that's strictly in my head that nobody else knows about. I look at a piece of property that, and I can give you many examples. Well, actually, I'll give you one. We acquired 77 million square feet on the edge of Colorado Springs. It's just under 1,800 acres for 23 cents a square foot. Now, unless you're used to doing that math, you might not be able to figure out if that's a good deal or not. But 23 cents a square foot is a good deal. I can tell you that categorically. Post-entitlement, post-annexation into the city of Colorado Springs, that land, just the land value on paper without putting infrastructure or anything else, should go somewhere between $4 to $5 a square foot. You can do the math. That's a pretty decent lift. Once you start to bring in infrastructure, water, sewer, electric, arterial roads, collector roads, and so on, now you're into the $7 to $12 a square foot. Yes, there's incremental investment required to get there, but every step along the way, we're adding value. Eventually, that property will be, home to 8,400 rooftops, commercial, retail, industrial, office, police, fire, schools, the whole nine yards. And that's a project that we initiated last year. For us, that's a legacy project. It's a massive project. But there was no competition for that idea. We came up with the master plan. We worked directly with the city. We did all of that development work. We did all of the environmental studies to make sure there weren't any endangered species living on the property and all of these other things that are necessary to be done that the average person can't access because maybe they haven't thought of it. Maybe they don't have the domain knowledge, but they aren't necessarily playing in that particular space. And there wasn't simply a lot of competition for that particular property, so we were able to get it at a great price.
That's interesting, too. Like, I would never think, and I guess that just comes with experience, like looking and see if endangered species live on a land, things like that. Because I'm sure that makes a big difference on what you can do with it.
Absolutely. Absolutely. It's all part of the due diligence process.
Now, so you work with people also that want to be involved in those types of deals, but may not know things like that. Like, hey, look for endangered species or all the different things. Like, how's your business work?
We're centered around 5 partners that are the core partners in the business. We have a number of employees as well. So our extended team is quite a bit larger. We're active in multiple markets all over the United States, a little bit in Canada, which is where I reside. We do development projects that make sense. It's got to be compelling. It's got to satisfy the laws of supply and demand on a sustained basis, not just on a short-term basis. And it has to meet those fundamentals. We're not going to say yes to any project, far from it. It's got to go through a pretty exacting criteria and a fairly lengthy due diligence process. And we kill a lot of projects. We kill a lot of projects that are good. Good isn't good enough. It's got to be fantastic in order for us to say yes to it. So that's a bit of the thought process.
How do you find your projects? Like, do you guys actively go out and find them, or do people bring them to you, or how's that work?
That's a great question. It's a question I get frequently, and the answer may sound arrogant, and it's not. When people ask me, how do I find projects? I really say I have no idea, because we don't go hunting for them. They literally all come to us. If you think about it, it makes sense. People will often stumble across things that they don't know how to execute on, don't know how to raise the money for, whatever the obstacle might be. And then they say, well, who might like to see this? And so it just ends up in our lap. The Norris Ranch in Colorado was one of those situations where it literally ended up in our lap. And it took us a while, in fact, to even get our head around the idea that we would do it. It took us a couple of weeks. In fact, we let it go at one point. We said, it's too big, it's too complicated, it's too whatever. And we said, now let's let it go. And then we thought about it and said, we can do this. And so we did, and we got it under contract and under very favorable terms. And we raised the capital, all equity, no debt. So, made sure that because this is a project that probably has a 15 to 20-year time horizon, we weren't going to be hamstrung by debt and be worrying about the meter running and are we going to run out of cash or anything like that. So it was important not only to put together a good project, but also to structure it properly so that it was going to be sustainable.
Guess it pays to be able to solve problems too that most people can't figure out.
Well, absolutely. In fact, that one's a very interesting project. Again, I don't want to keep going back to that one in particular, but our immediate neighbor to that property is Schriever Air Force Base, which is actually U.S. Space Command. It's the fastest growing part of the U.S. military. So they're growing. They have 7,000 people go through their front gates every day, but there's really very little infrastructure out there. So what would be helpful to them? Would a hotel be helpful? Would a daycare? All these other things that we have extracted through conversations directly with the leadership at Schriever has really helped guide some of the design of that master plan community. So it's not just things that we come up with in our head. It's got to be informed by what the market really needs.
Let's switch a little bit. I know you said how capital is like a pair of shoes.
Yes.
A little different direction. Explain what you're talking about there.
Oftentimes, so money has an agenda and projects have an agenda. And unless the goals for the project and the goals for the money match, don't take the money. It's not going to work. And often people will think about what is it, especially if they're out there looking to raise capital, they're saying, well, this person has capital. Why aren't they investing in my project? Well, it's probably because it doesn't fit. There isn't that perfect alignment between the goals for the money and the goals for the project. And the shoe analogy works from the point of view that if I said to you, you're walking through the mall and there's the most beautiful pair of shoes and gosh, it's your lucky day, they're on sale. If they don't fit, you're not a buyer. It doesn't matter how beautiful they are or how deeply discounted they are. If they don't fit, you're not a buyer. So we get it when we talk about shoes, but often people don't get it when we talk about money. So what is the fit for money? It's a whole list of criteria. It's things like what's the size of the investment? Someone is looking to write $5 million checks and you're looking for 50 grand. It's not going to work. It's not worth the paperwork to them. Their scarce item is time, not money. So, what's the size of the investment? What's the term of the investment? Meaning how long is the money going to be tied up for? What's the liquidity? What's the security? What's the risk? What's the tax consequence? What's the control structure? And on and on and on. There's all these different criteria. Now, unsophisticated investors often are not very clear on their investment criteria. They'd say, well, I just want to make money. Okay. But the more sophisticated the investor is, the more clear they're going to be on that criterion. Usually about a dozen of them. And you have to hit on all of them. If you get 9 out of 11 or 10 out of 12, it's not going to work. But that can be seductive because it almost works. And things that almost work don't. So it's really what we focus on first and foremost is in our conversations with investors is number one, this has to feel like a natural fit. If that fit isn't there, then we don't want to waste your time. We don't want to waste our time. And it's okay. There's no hard feelings. There's no problem. It's got to fit. It's got to feel like a natural fit. There should be nothing about it that feels forced in any way. And as soon as we lead with that conversation, it takes a lot of the angst and pressure away from the conversation, as it should, because there should be nothing about this that feels forced. And I have to say, there are people out there in this space that are out there being manipulative, being salespeople, trying to coerce people into parting with their cash and all of that. And it's just not our culture. We don't want any part of that. And frankly, it's not a sustainable way to grow a business, especially at the scale that we're at.
Yeah, I like that analogy too. Even like you're talking about, hey, if it meets 9 out of the 12 or 10 out of the 12 things, you got to be disciplined also because, yeah, I guess when you're thinking about shoes, you're not going to buy a pair of shoes that feel kind of okay.
Right.
Because you got to wear them all the time. Like you're married to them for however long you got them.
Exactly.
So it makes sense.
Exactly. And I learned this in the tech industry. That's where I learned to raise capital. And then when I moved into the world of real estate investing, I started out spending my own money, ran out just like everybody else does because it's a game of big dollars, and then had to relearn the process of raising capital. And when I did, I discovered that it was almost exactly the same, only easier. And it just became very clear for me. So back in 2017, I actually wrote a book called Magnetic Capital, specifically on this topic of how to raise money. What are the criteria that make it easy to raise capital, and what's missing when it gets really hard? And it really came down to 5 things. We talked about alignment, that fit, but there's more to it than that. There's elements like, have you actually got a relationship between the project and the capital? If that relationship doesn't exist, are they going to part with hundreds of thousands or millions of their life savings if there's no relationship? A lot of people will not. So, what is the nature of that relationship? What is the trust factor? Trust is a psychological contract that has a lot of layers. It's not just, are you dealing with an honest person? There's more to it than that. Number 3, what's your track record? People want to see success. And do you have a compelling opportunity? A lot of people, especially if they're new in this space, are just leading with the deal. They think, I've got a deal. It's all about the deal. And frankly, it's never about the deal, because a good deal badly managed is no deal. So what's the key word that's the differentiator in that sentence? It's the management. It's the quality of the people that are running the opportunity rather than just the deal itself, because deals are everywhere. It's really the only differentiator is the people. So it's never about the deal. And then the last one is the alignment piece that we talked about. So when all 5 of those are present, raising capital is fairly effortless. Now, it's been more difficult in the past year because a lot of people see a lot of uncertainty in the market. They're not sure what's happening in interest rates. They're saying, well, if I can get 5% in T-bills, why would I take any risk with my money? Well, yeah, and for a portion of your portfolio, that makes sense. But that shouldn't be your entire portfolio. There should be some portion of your portfolio that's focused on growth, because 5% in real interest rates, net of inflation, is still a very small number. You're not hoping the US dollar is going to appreciate. That's not going to happen. So what are you doing for the growth part of your portfolio? Are you going to go buy Tesla stock at 1,600 times earnings? Like what? Like,
yeah,
you got to do something that's a little less speculative than that, right? So there's got to be something in the middle there. And for us, we believe that real estate, real assets that are self-liquidating with income-generating revenue streams attached to them are the key. Inflation is a great bet. The only thing we're arguing about is what's the rate of inflation. The Fed has bookended it at one end at 2%. The market is probably saying it's a bit higher than that, but it's all more than zero. So we know through the magic of inflation that 3 things happen. Dollars get devalued, which means purchasing power for those on fixed income gets devalued. Debt gets devalued and savings get devalued. Those 3 things happen. So if you know that, how would you organize your affairs to come out on the winning side of that equation? Well, you would load up on as much debt as you can responsibly do and use that leverage to get the benefit of inflation to go to the equity side of the equation. It's not magic. It's very, very simple.
Right. Yeah, it's pretty simple there. You talk about buy on the line, move the line. What's that mean?
In virtually every city in America, there's a line. And on one side of that line, you've got a hot gentrified neighborhood. And on the other side of the line, you're in the hood. And often these lines exist for no particular reason. If you're sitting at home listening to this or watching this, you can visualize that in your own home city. Where you are in Pittsburgh, Brian, it exists. Where we've developed in Philadelphia, it exists. Like every city in America has that. Now, sometimes that boundary is a hard boundary. It might be a municipal boundary or a freeway or a railway line. Those are more difficult to move, but most of the time, those boundaries are arbitrary. If you just buy on the wrong side of that line at a fairly deep discount to the market, you can redevelop in the hood and now get valuations that are borrowed from that hot area immediately next door. Now, if you just do 1 or 2, it's probably not enough for the market to take notice. But if you do put a little bit of scale behind it, 5, 6, 10, then all of a sudden the market says, oh, I get it. The line has moved. Now, you might not get 100 cents on the dollar in terms of valuations from the hot neighborhood next door, but you will get a pretty good cent. You get 95 cents on the dollar or 97 cents on the dollar. And I say that from experience. We did an area, we bought probably 85, 90 properties in Philadelphia, North Philly, in an area that was the hood. And we moved that line. We redeveloped. We built a lot of, I'll say, small multifamily apartment buildings. And we expected we were going to get less than the full market value. But over time, we actually got 100 cents on the dollar. The thesis was, are people willing to pay a little bit less in rent to be a block away from the hot neighborhood? And the answer was yes.
That's interesting, too, because if you think about it, eventually over time, too, that may become the hot neighborhood also. Like it just absorbs in.
That's exactly what happened. Now the line's on the other side of your property, which means you can do it again and again and again.
Right. That's interesting. I never thought about that. That's a good strategy there.
It's worked very, very well for us, especially in an infill, in dense urban infill settings. And then often what you can do in that situation is you can figure out where the gaps are in the marketplace. And sometimes you just figure it out. You stumble across it by accident. Some of the properties we bought were 5, 6, 10 blocks from Temple University in Philadelphia. And we discovered that most of the people that were investing in student housing were building 3, 4, and 5 bedroom units and trying to cram as many students as possible. There's a shortage of 1s and 2s. We found that out because one of our 3 bedroom units was rented by a single individual. And we said, why are you renting this by yourself? And she said, well, there's nothing else available. I'm looking for a 1 or 2 bedroom, but I can't find it. So I'm renting this because that's the only thing I can find. So all of a sudden the light went off and we said, we need to focus on 1s and 2s. And that's what we did from that point forward. We didn't do any larger units in there. We only did 1s and 2s. So figure out where the gap is in the market. In the dense urban environment in Philadelphia, parking is a huge issue. So where possible, we would build, the city raised their height restriction from 35 to 38 feet. And that enabled us in a 3-story building to build ground level structured parking, elevate the building on a steel grid, and still do a 3-story walk up. But it was sitting on top of parking. So now all of a sudden parking differentiated the product in the market because nobody else had it. So you'd have to have a lot of vacancy for your building to experience any vacancy because you have one thing that nobody else has, and that's parking. So it's just thinking through where the need is in the marketplace.
Yeah, and solving problems. Solving problems is where the money is.
That's it.
Good stuff. Well, hey, Victor, we're about out of time. What's the best way for people to connect with you?
Well, I'm the host of the Real Estate Espresso podcast, a daily show 7 days a week. We're well over a couple of thousand episodes, been doing this a little while. So love to have you as a listener. That's Real Estate Espresso, like the Italian coffee. And to connect with me directly, our company is Y Street Capital. So it's the letter Y, streetcapital.com. And there's a link there. You can book a consult, and happy to chat with you and develop a relationship. So great to meet with any of your listeners.
Good stuff. And everybody listening, I'll have all the links in the show notes too, so you can just go and click them. Victor, last question. What's the top book you would recommend to people?
Oh my gosh, there's so many. Narrow it down, narrow the topic.
Your choice.
Every month I review a book of the month, first day of each month on the podcast. And the criteria for that book is it has to be very simple. It's got to either be impactful enough that it will change your life or your perspective on the world. And there are many that we've reviewed over the years on the podcast specifically with that in mind. If folks are getting started and they're new to entrepreneurship, I would recommend E-Myth by Michael Gerber. E is entrepreneurship, and it really helps break down what entrepreneurship is all about and the different roles. That's kind of a business 101 book, I would say. But there's so many. Ray Dalio Principles. There's just so many. But yeah, let's go with E-Myth.
All right, I like it. Hey, well, Victor, thanks for coming on, man. We appreciate you.
Thank you. Thanks for having me.
Hey, and everyone, thanks for listening. Get out there, crush it, close some deals. We'll see you guys next time.